Hello, hello, hello. Come in. I am Peter Martin, and I'm going to be your host today. I'm just going to give it a minute or two just to let uh, everyone get in case anyone's not quite ready yet. Just to check that you can hear me in the chat, can I just ask you put a Y or a yes in there just so that I can see that you are actually able to hear me? Good, great. I can see that you can all hear me. Hello and welcome. So, as I say, my name's Peter Martin. I'm going to be your host for this presentation, part 3 of the advanced aspects of trading course, which is on economic indicators, analyzing the economy and its impact on the markets. If you joined us for the first 2 parts, we were talking about fundamental analysis, a very granular approach, a bottom-up approach, and we're going to be taking a slightly different approach today, looking at a broader overview of the economy. Before we begin, I will just draw your attention to the disclaimer. Just please take a moment to read that. Just to stress everything I say today in this presentation, it is solely for educational purposes. And nothing I say should be taken as a recommendation or a solicitation to buy or sell any financial instruments. It's all just about broadening your knowledge. I'd also say, if you've got any questions as we're going along, make a note of them, save them up for the end. We will have 10, 12, 15 minutes maybe at the end to take any questions you have. Okay, so the agenda for today's presentation. We're going to have an introduction where we'll be talking about the macroeconomy, about the importance of the US economy. And then we'll be moving on to look at the business cycle, talking about what that is and why it's important. And then we're going to look at what we call indicators, economic releases that tell us about where we are in the business cycle, GDP, a very comprehensive measure of what's going on with the economy, the monthly employment report that you get in the US, which is the most closely followed report by market participants. We're talking about why that is so important. We'll look at some other key indicators, and then we're going to finish off by looking at the FOMC rate meeting. This is the policy meeting for the Federal Reserve, the central bank for the US, and it's a very crucial event if you're a trader or an investor or an economist. And we'll finish up with those questions. Okay, so we're going to begin with this quote from John Maynard Keynes, sometimes called the father of macroeconomic analysis. And the quote says, "The inactive investor who takes up an obstinate attitude about his holdings and refuses to change his opinion merely because facts and circumstances have changed is the one who in the long run comes to grievous loss." So really what he's talking about here is flexibility, which we need as a key trait as a trader or an investor, the flexibility to change according to how conditions change. And it follows that if we're going to be able to do that successfully, we have to be cognizant of what changes are happening. And that's really what this talk is all about. So as I said before, in the previous 2 presentations, we were doing a bottom-up analysis, fundamental analysis, looking at the granular parts of a company, its sales and its profits and its capital expenditure. We're broadening that approach. We're going to do a top-down analysis, trying to look at the broader economy, how that kind of wind, which direction the wind is blowing in terms of the broader economy. So how the economy is faring has an effect, and a significant effect, on companies and financial markets. So if the broad economy is strong, then that is like a tailwind helping the companies to do well. If the economy as a whole is weak, then that's like a headwind. It sort of constrains what companies are able to achieve. It makes it harder to do well. So we need to know how the economy is faring. And we do that through a variety of what we call indicators, economic releases that tell us how things are going. We're going to talk just now about the importance of the US economy. We've got this old market aphorism. Used to work in the markets for many years, and I can remember being told this quite a few times. When the US sneezes, Europe catches a cold, and that's sometimes extended to and Asia catches pneumonia. And effectively what it's saying is that the US is really important. It has an effect on global trading. Why is that? Well, if we look at the size of GDPs of leading nations in terms of GDP, we can see that the US by far is the biggest economy in the world. So we've got this little table on the right here showing you the GDPs of a few companies. The USA, trillions of dollars, 23.2, much bigger than even its closest competitor. So China's the only nation that's remotely close in size. We can see it's still got quite a long way to go to catch up with the US. The Eurozone as a whole is similar in size to China. So even the Eurozone as a whole, a big economic powerhouse that it is still behind the US in terms of GDP. So the US is really important. It has a big impact when data comes out telling us how the US is doing. Now let's talk about the business cycle. And the business cycle is at the heart, really, of how we think about capitalist economies. It's the heart of modern economic thinking. And the strict definition, a fluctuation in the aggregate economic activity of capitalist economies. So a business cycle consists of an expansion in many areas at roughly the same time, followed by a similarly broad contraction, which then sort of merges into the next expansionary phase when we get a revival, and then into, as I say, this next expansionary phase. These cycles of contraction and expansion differ in length. In fact, no two are exactly the same alike. We often call the contractionary phase a recession. The strict definition, technical definition of a recession is 2 quarters of declining GDP. So let's just look at this kind of simplified and idealized version of what I was just talking about. So on the left, we've got on the y-axis, GDP, gross domestic product, a measure of how the economy is doing. On the left, on the x-axis, we have time, and we can see we have these alternating phases of expansion and contraction in economic activity. So at the peak, the economy is firing on all cylinders. It's going full pelt. After the peak, we can see that the economic activity starts to slow. Business activity starts to slow. This is a testing time for companies. Weak companies might fail. Even the best companies find that it's harder to grow sales, to maintain profits, to keep growing. When we get to the trough, it's the rock bottom. Many economic indicators are going to be showing extreme weakness. But following on from the trough, we begin a period of recovery. And in the expansionary phase, business activity is picking up steam. Companies are finding it easier to do well, to generate sales, to make profits, to grow, and so on. In the US, I'm going to focus on the US because the US economy is so important. It's the big mover and shaker of financial markets. The Bureau of Economic Research, the National Bureau of Economic Research, the NBER, records the chronology of the business cycle. So they are the arbiters of when these things occur, when we get peaks and troughs, when we're in a recession or not. And they've recorded 4 recessions in the US since 1990. So there was one in 1990. There was another in the kind of dot-com boom and then bust in the bust period in 2001. And then there was the big financial crisis in 2007 through to 2009. And then fairly recently, I'm sure you all remember this, we had the COVID-related kind of flash recession in March 2020 and April 2020. So if you remember any of those in the chat, why don't you just let me know if there's one there or multiple ones of those, which ones you remember, share with us so we can see. I'll be interested to see which ones you remember, whether you're old enough to remember, if there's anyone who's old enough to remember the one back in 1990 or even the one in 2001. I'm sure there's quite a few who remember the financial crisis and obviously COVID. So the NBER makes a retrospective decision on when peaks and troughs occur. And as we saw from that diagram we just looked at, the peaks and troughs are really important because what they do is they mark turning points in the economy. So the peak we saw is at the top, but it's immediately followed or followed closely after by going from the previous expansionary phase into the contractionary phase. And the trough is then a turning point from the previous contraction into a new expansionary phase. So it's really important to recognize where these parts are in the cycle because they're going to really let us know about how easy or difficult companies are going to be finding the going. So what we can use to try and clue us in on this is to use indicators. So an indicator is a release of a piece of economic data to the public for a given period. And these are broadly classified into three different types. That is according to their relationship with the business cycle. So we get coincident indicators, and these are pretty common, and they are ones where it is actually happening at the same time. So it reflects the current state of the economy. And then we get lagging indicators. They actually tell you afterwards, but they help you confirm that it's definitely happened. So it doesn't sound that useful, but it is useful because it allows you to actually make that retrospective confirmation. Okay, we have definitely seen a peak or we have definitely seen a trough. And the NBER, when we were talking about where they're the official arbiters of where the peaks and troughs are and where the recessions are, they always do it in a lagging way. It's always afterwards that they confirm this has happened. And then we also have these indicators, which sound incredibly useful, which are leading indicators. They predict forthcoming changes in the cycle, which is to say that they have exhibited historically some kind of predictive quality. So when they show an upturn, for example, that is ahead or where that upturn is not yet apparent in the broader economy. Now, indicators all have a different set time of release. They come out according to a set schedule. And then alongside this, there is a consensus that usually is known ahead of time. So this is where we've polled, or a group of Wall Street analysts have been polled about what they think the outcome will be. And then there is a median estimate that is called the consensus estimate. This is very similar. If you attended any of our previous presentations, can you remember we talked about the earnings season and how analysts will have their consensus estimate for what earnings and what profits might be for, earnings and revenue for companies might be. So it's a similar kind of thing. And when we said there is that is when you get the divergences from expectation that you usually get the biggest market reaction. It depends which indicator, because some indicators are more important than others. So pretty obvious tip, but a very useful one. Make sure you familiarize yourself with what those expectations are before the economic release comes out. So you've got in your head, okay, that's what's expected. I can see the headline diverges, either it's better or it's worse. And then you've got a rough idea of how it might affect things. And then you'll have an idea about how you might want to position yourself. So here we just have an example of what releases might look like for any given day. So there's numerous economic releases coming out. They're coming out all the time. Some are low impact, some might be high impact. So what we need to do is have an idea about what actually is important, because we don't have the time to look at all of them and analyze every single one. You just want to be focusing as traders on the most important ones. So let's talk about a really important one, which is GDP, which is the broadest, most thorough measure of a nation's economy. So if any one indicator could be thought of as being the definitive one that's telling us about where we are in the cycle, GDP is probably the best candidate. So it stands for gross domestic product, and it's the sum of values of all final goods and services produced in a country for a given period, usually a quarter, using the country's own resources, irrespective of ownership of those resources. So it doesn't matter who owns the stuff that's being produced, it's just where it's being produced that defines whether it makes it into the GDP or not. So just to give you an example, if we were looking at Honda cars manufactured in the US, they would contribute to US GDP. So it doesn't matter that Honda is not ultimately under US ownership. It's the fact that these cars are made in the US, then they would contribute. Harley Davidson, a US company, Harley Davidson motorbikes, if they're manufactured in its factories in Brazil or Asia, they don't contribute to US GDP because they're not made in the US. They just don't meet the criteria. And then, just as mildly useful to know, there is another measure alongside GDP called GNP, the gross national product. That's a measure that does include overseas US owned production. So it's slightly different criteria. GDP is usually the one that's preferred as a measure over GNP by economists, investors, traders, because of its focus on domestic resources. So US GDP is calculated and reported on a quarterly basis by the BEA, the Bureau of Economic Analysis. And every day report contains data on personal income and spending, corporate profits, national income, and inflation. Economists usually compare latest data to the previous quarter to infer how the economy is performing and where it might be heading. So we look at current quarter, previous quarter, is it expanding? Is it contracting? You can also compare it to how things were a year ago. And then when this comes out, there are 3 versions released for every quarter. So we get the first one, which is the advanced one. It's the earliest one. And it comes out about a month after the quarter ends. And then about a month later, we get the second one, which used to be called the preliminary. And then we get the third one, which is used to be called the final. And it is the final one. So that's the definitive final one. They stop revising the data after that. So the GDP report, it's an incredibly comprehensive report. It contains a treasure trove of data about the economy. There's all sorts of stuff in it that can tell you all sorts of things. As traders, we really just want to focus on the most important bits because we don't have the time to sort of be looking through the whole report to make up a decision about what we want to do. Different sections of the report cover different parts and activities. We're most interested in, as we've said already, in divergences from expectations. The greater that divergence, the greater the impact. Now, as we'll come on to see, the impact of the GDP report can be quite limited because of its lack of timeliness, which is what we're going to explain in just a second. And the headline figure is GDP change. It's expressed either as quarter over quarter or year over year. Generally speaking, if things come in higher than expected, that's bullish for stocks, bullish for the US dollar, bearish for bonds. Stress, ceteris paribus, all other things being equal. And we also have to put it in context with what the kind of current environment. We have to use our judgment and experience to work out what's going on. For example, currently we're in a kind of high inflation environment. People are worried about interest rates being tightened in response. So we have to bear that in mind. A very bullish report might not be viewed quite so, a strong GDP report might not be quite so bullish for stocks if people are worried about the Fed hiking interest rates. So you have to use your common sense, and then vice versa, lower than expected, ceteris paribus, bearish for stocks, bearish for US dollar, bullish for bonds, generally speaking. So also in the report, some other key pieces of information, we have these things called deflators. Effectively, they're things that track price changes, and therefore they're indicators of inflation. When we measure GDP, it measures prices of goods, and therefore it's subject to inflation. The reason the deflators are recorded is so that we can use them to deflate these values to take out the effects of inflation and see things in real terms. The deflators, as it says here, they are watched pretty closely by the Fed, particularly this thing called the PCE price index X food and energy. So that's the personal consumer expenditure, i.e. consumer spending price index, excluding food and energy prices. Why do we strip out food and energy prices? Well, food and energy prices pretty volatile, so they don't actually necessarily tell you too much about long-term trends. They can just whip around, flip them out, so we can look at the core changes, the underlying changes, the underlying trends in what's going on with inflation. So knowing that the Fed closely watches the PCE deflator, if that's greater than expected, generally speaking, that would usually pressure bond prices because it increases expectation of rate hikes. If rates go up, it makes bonds with their fixed yield or their fixed coupon less attractive. So consumption expenditures, consumer spending, when the economy is weak, you can often see it in how people are spending their money, consumer spending habits. And consumer spending, particularly in the US, is a major driver of GDP growth. We also get information about investment spending split into residential and non-residential. Non-residential spending is much bigger than residential, but residential tends to have these kind of ancillary effects, i.e. if people are spending money on buying a house, they're probably going to be spending money on decorating it, furniture, maybe buying big ticket items like fridges and so on. Non-residential spending is a guide to corporate spending. And corporate spending, if it's high, well, it tells you a little bit about corporate profits, about how confident companies are. So some useful information in there. But we have a problem with GDP, actually, which will come on after this slide. So here's a quick example of a report from the BEA about GDP. So this is like a historical case study. So it's data for the fourth quarter of 2022. That comes out 8:30 Eastern Standard Time, 1:30 in the UK. The advance estimate, so this is for the fourth quarter of 2022, it came out the end of January 2023, so about a month after the end of that quarter, as we said before. And then the second estimate came out roughly a month later after that, 23rd of February 2023. And then the third estimate came out on the 30th of March 2023. So there is a bit of a problem there, which is to do with how late all this information is being made available. So I've marked on here this chart so you can sort of just have a look at how it all tallies up. So we've got the fourth quarter here in blue, October, November, December from 2022. And then in January of the following year, we get the first estimate right at the end of January. And that estimate doesn't actually include data from December. It has the information in from October and November. So it's only got the older data in. And then as the newer estimates come in, they start to incorporate newer data. So they will incorporate data from December. They might revise some of the stuff that they had in the January estimate. But the problem is with the second and third estimate, although they've got that newer data from December, by the time they're being released, that's old data as well. So even the early advance estimate is reporting old data, and then as time goes on, they're reporting increasingly like really old news. So what I'm trying to show with this slide is that we can look for a proxy for GDP with something else that comes out a bit quicker. So what I've got plotted on this chart is we've got yearly changes in on-farm payrolls plotted with this green line here. And then the blue bars represent US real GDP, yearly change. And then these orange bits overlaid, the shaded parts, show you the recessions. And what we can see, if we look at how the two move, the non-farm payrolls and the GDP, we can see that they move together. They show a real tendency to go up and down together at pretty much the same time. So historically, there's been this very high correlation between non-farm payrolls with US GDP. So we can use, if we want, the theory goes, non-farm payrolls as a proxy for GDP. And the employment situation, non-farm payrolls is part of the employment situation, is the most important economic release in the monthly calendar. Traders eagerly await this report. So when I used to work on a trading desk, we were all told 1:30 in the afternoon, which is on a first Friday of the month, which is when the report comes on, you had better be at your desk ready 5 minutes before that. You either take your lunch early or you take your lunch late or you don't take a lunch at all, but you are there in your seat because the markets are probably going to move quite a bit. So the report has a tendency to move the markets, potentially an awful lot. It's released by the Bureau of Labor Statistics, BLS. It's not K-pop. On the first Friday of the month at 1:30 UK time, 8:30 US time. And it's this point at the bottom that is why it's so important, because it's much more timely than GDP data. So we've shown that it can be used as a proxy for GDP, but it comes out much earlier. So if we mark on that same chart we had before, so we've got the first estimate, second estimate, and third estimate of GDP with the big delay. If we put on where the payroll data comes, October ends, payroll data is out straight away in the early November. November ends, we get payroll data early December. December ends, we get December payroll data early January. It's incredibly timely. We're getting the data, very fresh information, and we know that it correlates historically with GDP. So it's a great clue of what's going on with the economy. So the employment situation report itself, it contains two sets of tables. So we've got the current population survey, CPS, often known as the household survey. And then we've got the current employment statistics survey, CES, establishment of payrolls. Of these two sets of data, traders focus much more closely on the payrolls survey, the second of the two. And it's really just two headline numbers that we tend to focus on, the headline numbers, or get the most consideration. That's the change in non-farm payrolls. That's the one we've just been plotting on that little, we were showing how it correlates with GDP. So that's month over month. And we also get the unemployment rate. There is quite a lot of other important data contained within the report. We've got things like hours worked, average hourly earnings, overtime hours worked, monthly change in manufacturing employment. And that can tell you quite a lot about how companies are approaching things, how tight the labor market is, what kind of jobs are hiring, how comfortable companies are about hiring people, tells you about how confident they are about how things are going. So there's lots of useful stuff in there. But as I said before, it is really just the two things that people get the most attention, which is non-farm payrolls and the unemployment rate. So non-farm payrolls comes from a survey of hundreds of thousands of businesses. So it's very comprehensive, and it tells you the number of jobs that were added to payrolls or the number of jobs that were lost over the period in question. And what is called non-farm payrolls, that's because it excludes farm workers. Why do we do that? Well, farm workers are hired according to what time of year it is. So, there'll be extra people brought on in harvest season. People will be laid off when it comes to the winter, and that will happen every year. It's a seasonal distortion. We strip that out because it doesn't tell us about what's going on in terms of trends in the economy. It just tells you about what's going on in terms of winter and summer. So we exclude farm workers. And then we also, alongside that overall change in the numbers, you also get it down broken by sector and by certain industries. So it gives you some kind of granularity if you're interested in seeing where those changes are. Particularly useful is non-farm, non-governmental payroll. So if you're looking at the non-governmental, you might get a situation where Government hiring remains robust, but if non-governmental companies got very weak numbers and payrolls, the jobs are dropping, that can show you a real lack of confidence in the private sector about where things are heading. So it can be quite useful to look at. Something that's worth just knowing is the unemployment in that report, how they classify who is employed and unemployed. There are a few quirks in there. Employed are classified as people who's working as an employee. Duh. Self-employed or on temporary leave. That temporary leave can be paid or unpaid. If you're on temporary leave, you're unpaid, you still count as being employed. If you're working in a family business and you work more than a certain period in the month, you can still be classified as employed. Unemployed means you're not working, but you are actively seeking employment. So if you aren't actively seeking employment, you are classified as a discouraged worker and you don't count towards the unemployment rate. So sometimes you can see slight quirks that can appear confusing, where you see things like a big jump in the payrolls, lots of jobs being created, and the unemployment rate goes up. And it can seem a bit inexplicable, but that can be people being encouraged by the labor market being strong, coming back in, who previously discouraged workers are now seeking work actively, and they join the ranks of the unemployed in terms of the classifications. So the importance of employment. We're saying this report's incredibly important. We know that it correlates highly with GDP, but why? Well, here's a quote from ex-President Harry S. Truman. It's a recession when your neighbor loses his job. It's a depression when you lose yours. So it has a big effect on consumer sentiment. It can be devastating if you lose your job, and that can knock your confidence and your approach to spending. And as we said, consumer spending is a big part of GDP. So just summarize some of the things we've said. The employment report is one of the first major economic reports of every month. So you get it incredibly timely. It's incredibly useful. It's one of the first ones released. That's why it's so closely followed. There's a strong relationship with employment and a lot of other important economic indicators. It's closely watched by the Federal Reserve, so has implications for what might be happening with monetary policy. If we see multiple consecutive months of downturns, of employment drops, that usually coincides with an economic downturn. As we said before, unemployment has a big effect on consumer sentiment, and that will knock on to spending. It's a key idea that we always need to compare what we're seeing to expectations. So if it comes out stronger than expected, it can often be beneficial for stocks, can often be beneficial for the US dollar. It increases expectations usually of a possible of tightening monetary policy, which is the effect on the US dollar. Weaker payrolls than expected is usually pressures stocks. It can pressure USD, but we do need to consider these inflationary pressures. So we need to tie into the effect. So if it's stronger than expected, this ties into the idea of it being correlated with economic growth. It looks like good things are strong for the economy. Companies are probably going to be doing well. It has an implication for what their profits might be, or how easy they're going to be finding it to do well in business. But tied in with that, if the economy grows too strongly, one of the things can happen is that prices rise. If prices rise, then we get inflation. Well, that is inflation. And if the Fed responds by tightening, that can have a constraining effect. So we need to sort of just factor this in with our judgment. And we also need to pay attention to revisions to previous months. So in the report, the headline might be for example, a big increase in payrolls, but you often get you will get these changes reported from time to time to previous months. So sometimes you might see a big increase in the current month, but alongside it, there's also a downward revision to the previous month. Often you get a kind of knee-jerk reaction straight away to the headline figure, and maybe there's a little correction to that afterwards that reflects in some of those revisions. So here's just an example of earlier in the year. First Friday, Friday the 10th of March when the report came out. So the employment situation summary released here by the Bureau of Labor Statistics. Non-farm payroll employment rose by 310,000 in February, and the unemployment rate edged up to 3.6%. So the actual payrolls, amounts was much stronger than the consensus estimates for payrolls. The unemployment rate, though, was also higher than expected. But then there was also this revision for December and January of down 33,000. And here we just see that represented graphically, can make it a little bit easier to see. So we had that expected 205,000 increase, the actual much, much higher, and the unemployment rate also came out higher. And then with these downward revisions for December and January. Here's what happened with the S&P 500 and with euro dollar FX rate. So we've got the chart at the top is the S&P 500. This green bit, this green shaded area shows you the period in question. This is on a periodicity of 10 minutes, this chart. The actual release at 1:30, we get this big green candle. So we can see just how much prices moved. Before the release, prices were moving sideways. The amount they were moving is pretty muted. Afterwards, got a lot more volatility, but things ultimately end up being not too far away from where they began. Similar story with euro dollar, apart from prices don't end up where they were before. So things were pretty muted beforehand, moving sideways. Big response in the actual aftermath of the release. Direct aftermath prices rocketed up. The euro dollar rate rocketed up, as did the S&P prices. But then we also see the rate afterwards just really pushing on and ending up at a much higher rate afterwards. So the report itself is what you might call a mixed report. Headline payroll growth was really strong, 300,000 added on, but it was undercut somewhat by that pretty big increase in unemployment, which was unexpected, and then a narrowness of gains in terms of industries, and then softening wage growth. So some of the details did play a part ultimately. So we saw initially the market responding to the headline numbers, but then some of the detail behind it started to undercut it slightly. And also, it eased expectations for the steepness of Fed rate hikes. So some other key US indicators that we might want to pay attention to. So first on this list are consumer sentiment measures. We said consumer sentiment has implications for consumer spending. It can give you an early steer, shall we say. There's a couple of closely followed ones. The Consumer Confidence Index released by the Conference Board, and then the University of Michigan Sentiment Index, usually just called the University of Michigan report. Those two try to measure what's going on with consumer sentiment and are closely followed. And then we have measures of inflation. We said before that there was the PCE index that in the GDP report. There's also here's a couple more, PPI and CPI. CPI is the Consumer Price Index. It's a narrow basket of goods, so it's a narrower measure than the one that's in the GDP report, but it comes out a bit more timely. And PPI, Producer Price Index, sometimes called wholesale prices or factory gate prices. So this is what the wholesalers are actually paying. So it's a bit earlier in the pipe. So this can sometimes clue you in a bit earlier as to what might be ultimately coming down to consumers further down the line. But then again, wholesalers may not pass it on to consumers, but it's a useful piece of information. And then at the bottom, we've got some manufacturing gauges, the ISM PMI. So this is the Institute for Supply Management. the PMI is Purchasing Managers Index. So they actually survey purchasing managers at manufacturing companies. So these are people who are doing the actual buying. So they've got they really are really useful eyes on the ground as to what's going on. The numbers aren't cold, hard numbers. So what's going on with these things is compiled as what's called a diffusion index. They survey the purchasing managers, ask them questions about, do things are the same? Are they better? Are they worse? And then from that, they crunch it together to come up with a kind of number that you can compare whether things have got better or worse than the previous month. Other measures, that's probably the most closely measure of manufacturing. There's also capacity utilization, how much factories are running close to this theoretical level of full usage, and industrial production, how much is being produced at various companies with a manufacturing or industrial slant. Manufacturing, once again, it's useful for kind of giving you an early steer about what might be happening, because manufacturing is seen as although it's only a fairly smallish part of the US economy these days, it is seen as a kind of bellwether about what's going on. It's kind of an early warning. So we're going to finish up by looking at the FOMC meeting, which is the monetary policy meeting of the Federal Reserve, the central bank of the US. So this isn't an economic indicator, but it is a really important date in the economic calendar. So you always should be aware of when this is coming out. And I would say also, I focus very much on the US here because the US economy is so strong. Obviously, there are equivalents to these for other economies. So the MPC for the UK, defining from the Bank of England, defining monetary policy for the UK. The ECB, the European Central Bank, has a monthly meeting, or will have periodic meetings where they decide on the course of monetary policy as well. If you're interested, if you're holding UK stocks, of course, you're going to pay attention to UK data as well. But because the US is such a big market and shaker, that's why I'm focusing on the FOMC meeting. So the Federal Open Market Committee, the FOMC, it decides US monetary policy. They hold 8 scheduled meetings per year. So they don't meet on a monthly basis. There's a couple of months where they miss out a meeting. And the Fed uses tools at its disposal to effectively set what's called the federal funds rate. It's a key interest rate that lending institutions use. Really, it has a knock-on effect on other interest rates and the economy. So it influences other short-term and long-term interest rates. And then that has a knock-on effect on many variables: forex, credit, employment, and prices. So the Fed has this dual mandate. The stated aim of their monetary policy is to promote maximum employment and to promote price stability. So they're always trying to keep the jobs market strong, but they can't do that at the cost of causing price instability. So they have to have an eye on keeping things steady. And the primary way they do this is by tightening, raising rates, make rates higher. They'll do that usually as a response if they think that inflation is too high than their desired target, or lowering rates, which we call easing, usually a response to sluggish growth or low employment. And where this can have the biggest effects on the markets is if these rate changes are unexpected, if they come out of the blue. Now, that doesn't happen very often. And one of the reasons that the Fed has got much better over the years is communicating what it thinks, or communicating the way it's thinking with its guidance about future changes. So they're very careful about the language they use in their statements. And the language, as I say, is very carefully thought out. What I want to do is I'll share with you just a second, if you bear with me. So here is the page from the Federal Reserve themselves. This is just their list of FOMC meetings for 2023. We can see they last had a meeting in September. They've got the next meeting is coming up. It begins the end of this month on the 31st. It's a 2-day meeting. So they sit down for a couple of days. Then at the end of the meeting, they release their statement. If we look at the last statement from the September meeting, we can see what they talk about, how they view the economy, how robust they think they are. They restate their goals, their inflation target rate is 2%. And then in support of those goals, they say the decision here was no change in the federal funds rate, which has this sort of range between 5.25% to 5.5%. So this language will be very, very similar to the previous language. If you look at what they did for the June meeting, you'll see that the statement is almost the same. And what will change will just be, if anything, just a couple or, a word or two here or there that subtly just sort of teases out the way they see things. They don't use anything. They try to avoid drama effectively, which is to try and stop causing volatility in the markets. So let's go back to our presentation. And alongside having these post-meeting statements, they also have press conferences, and what is said by the chairman of the Federal Reserve currently, Jerome Powell, that can have a big effect as well. People sort of hang on everything he says just to see if they can get any kind of clue out of what's going, or the way he sees things, or the way they might be thinking about future changes. The Fed didn't always used to have a press conference after every meeting, but then that sort of led to a kind of thinking that they would never make a change at a meeting that didn't have a press conference. So to try and get rid of that thinking, they added a press conference after every meeting, which is the way things are currently. So just to summarize some of the stuff that we've spoken about, the performance of the US economy has a global influence. It's the big mover and shaker in terms of the global economy is the US because of the size of its economy. We saw just how big US GDP is. A lot of these indicators that we've talked about, though, will exist for other areas. So just as we have CPI as a measure of consumer inflation in the US, we have CPI for the UK, CPI for Germany, for France, for the Eurozone as a whole. And these will all be released according to a certain schedule. Actually, I'm just going to share another screen again. If you bear with me a second. If I go, so here we are in eToro's platform. They actually have an economic calendar. I'm just clicking on that now. And this can be pretty useful. Economic calendars, they're readily available online, but there is one here within eToro's platform that's pretty useful. You can see that it's got earnings reports listed for October. But we can also see, like, for example, we have Eurozone CPI data there at the end of September, and then CPI data for the US came out on the 12th. We've got some more here that was today for the Eurozone. And then we have interest rate decision from the ECB on the 26th of October. So there's an economic calendar there. So it's very easy to stay on top of when things are coming out, and you can look up the consensus estimates so that you can get comfortable and familiar with what the expectations are, so that you can act more readily if you need to. Where we are in the business cycle influences how stocks perform in general. So we said when in a contractionary phase, then businesses find it tough. When the economy is expanding, businesses find it easier to do well. Identifying or predicting turning points is vital. So identifying if we can see where we got a peak or a trough, then afterwards the cycle will change. And that's vital information for investors and for traders. We talked about how GDP was the most comprehensive measure of the economy, the widest, the most in-depth report, but its lack of timeliness constrains its usefulness to a large degree. And so the timeliness of non-farm payrolls, because it correlates with GDP, makes it a really useful proxy for GDP and therefore how the economy is doing as a whole. And then finally, FOMC decisions, the Federal Open Market Committee decisions, are influenced by economic strength or by economic sluggishness and what's going on with inflation. Okay, so that is the end of the talk. And now we've got an opportunity. If anyone has any questions, please ask them now. I can see there's some in Q&A right there, so I will go to that.
Hey.
Hi, Matty. So we have Matty with us as well. He may join in.
I was listening the whole time, so sorry I was joining late.
Oh, don't worry.
I shared something in the beginning, and I would like to share it just again before we start answering questions. We happily managed to get an exclusive 10% discount to gurufocus.com. So I'm sharing now the link. You're all welcome to use it. eToro doesn't have any benefit from it. It's purely for you. We just use it for our analysis, so we thought it's going to be nice. We approached the CEO. Guru Focus is known to be one of the best places for doing analysis from all type of, especially fundamental, but just for you to know. But yeah, I mean, we can take some question if you want to go through them, Peter, or I, or whatever.
Sure. No, I'm just having a look through at some of the questions, trying to see which. Well, the one question here is, could you comment on the high unemployment rate and persistent inflation? How could the Fed move on? Well, obviously, I don't have a crystal ball and I don't know what the Fed's going to do. What I would say is the effects of tightening, and the Fed has been in a tightening cycle, the effects can be quite slow to filter through. And this isn't just limited to the US. It's true of other economies. It's true in Canada and in the UK as well. So what will happen is that the Fed, or the central bank in question, will hike rates because they're seeing inflation going up and they want to constrain that inflation. But it won't have an immediate effect. So it might have an immediate effect on the markets, because the markets are paying attention to what the Fed's doing. But your average person in the street, they're not going to be saying, oh, well, the Fed's hike rates, I'm going to stop spending my money. It takes time for that to hit them. And the way that it takes time to hit them is because of the way that mortgage rates are structured, and that a lot of people are actually on a fixed rate that isn't affected by that hike until a certain period has gone through. So there can be a very long lag before that starts to actually hit the consumer in the street directly via what they pay in terms of monthly payments on their mortgage rates. And that could be 18 months, 2 years before it starts to really bite, and then you can see this delayed effect. So certainly I've seen in some nations, so in Canada, for example, the inflation rate has started to really level off, and that's because the quite famously conservative in behavior central bank of the Bank of Canada, they got into a tightening cycle much earlier than other major central banks. You're seeing it there. So the Fed has been, though, in this fairly strong tightening cycle. Rates are quite high. Basically, what the Fed will do is keep a close eye on the economic data coming out in terms of inflation, and that will govern what they do. They will be led by the data, and it's as simple as that. So, the question you ask, high unemployment rate, persistent inflation, those are the two things two of the key things they'll be looking at. if you look at what their forward guidance is, it will give you a clue. But their forward guidance always basically includes the language that we will be effectively led by the data. So they'll be looking, and they will, under the Fed as well, they've got a lot of talented economists working for them who are building models about how they see things going, and they'll have a good idea about how this will probably their earlier rate hikes will start to bite at some point. And so I don't think they'd be too worried. Obviously there's certain events going on in the world that can impact inflation, which is out of their hands really, but they will be keeping an eye on the incoming data. And then another question here. Let's have a look. Hi, I've been hearing about recession fears for the last 2 years. Even the theory definition of two consecutive GDPs declining accomplished, nothing happened. What do you reckon happened, or will it happen at all? Once again, I don't have a crystal ball. We have been going through an incredible period. I mean, I've been working in the markets since the 1990s, and I've seen a few recessions. I've never seen a bull run this long. So, post-financial crisis, we started the economy, we got into an expansionary phase once we came out of that, and we got into an incredible bull run in terms of stock prices that lasted over a decade. It was pretty much unprecedented as far as I can remember. So, I mean, the typical length of a bullish cycle before you start seeing the next contractionary phase, maybe 5 years, 6 years. Historically, we've already busted well beyond that. So came as a surprise to me. I started thinking a long time ago, well, we've got to be getting towards the end of the period, so it shows what I know. But we also had pretty unprecedented behavior from the central banks in response to the financial crisis, where they took they called it themselves extraordinary measures, where they just effectively created a lot of money and handed it out. And we sort of saw a lot of cash being handed out during COVID to try and get the economies through it effectively. So we're still trying to work through some of that stuff. I mean, the idea that we never get another recession would be fanciful. It will come. I don't know when, because I don't have the crystal ball. Like the Fed, I'll be monitoring the economic data and looking to see what does happen, and then I will react according to what I see happening. So someone asking, in this market, is a higher unemployment good or bad? This because of getting good people working, finding good staff. So a higher unemployed could benefit the company of getting qualified staff and not overpaying to keep staff. Well, there's been no doubt about it that the labor market has been incredibly tight. And, I think we've all heard stories about certain companies finding it hard to find staff. Certainly, where I am, I hear lots of stories about restaurants struggling to find just sort of casual labor to, people to serve tables during the day and things like this. So effectively, when it is that tight, what you usually see is high inflation, because employers have to compete to get the workers. And I think it's not too much of a great coincidence that we have been seeing very, very high inflation rates, or at least, according to the kind of inflation rates we've been seeing since, the last 10, 15 years. But that is because we've been in what is historically a very low inflationary environment compared to what you've seen historically. Like, so the kind of rates of inflation at the moment aren't actually that high compared to if you go back to the 70s or the early 80s, those kind of periods where you might see inflation rates much, much higher and interest rates much, much higher. Um, I don't think there's anything bad about having low unemployment, because low unemployment means people have got jobs and people have got income and people are doing well. So I don't think that higher unemployment is something we would want to be actively seeking. A robust labor market is good for consumers, and consumers are good for the. I think we're working our way through a few distortions post COVID. The economy is likely going to handle it, but there's probably going to be a bit of ructions, as there always are. But I can't foresee what's going to happen. But I don't think there's anything bad about having low unemployment per se. Lots of employment and inflation questions. Oh, so someone asked, could I share the link for the registration on the next sessions? And I should be able to. I do have them here. Let me give you the one. We've just done number 3. So, actually, I should be able to do the rest here. So I'm going to put this in the chat now. Hopefully you can see those. Somebody give me a Y. Yep, someone says thank you. Great. Someone has actually, it's an excellent question here. Why do better employment figures sometimes send the market down? It is an excellent question. It's not so easy to answer, though. I would say, it's difficult to sort of answer in the general. It's easier if you had a specific example, because we could actually look at what's there and say, okay, it's maybe this, maybe that. I'll give you some kind of general reasons why it might be. So you might have 100,000 jobs are added, pretty good figures, but maybe the expectations were for 180,000 being added. That could be a reason why. So it's actually undershot expectations and the market reacts poorly in terms of the stock market. You might have that you get 100,000 jobs added was expected and 120,000 was added, so better than expected, should be bullish. But then maybe the unemployment rate was higher than expected. So that might be another way. So it's undercut by other details. And furthermore, you might get it being undercut by other details. So a classic one might be, once again, I'm just using this standard 100,000 because it's easy to say, but you might have 50,000 jobs expected, 100,000 were added. And when you look at the detail, 120,000 jobs were added in government work, but actually you lost 20,000 in the private sector. And someone might look at that and say, well, hang on. Okay, I think that the private sector is a better guide to what's actually going on with the economy than government spending, which is a little bit removed from the sort of harsh realities of the economy. So those are just some ideas how you might get things like that. And sometimes the market can just be odd. Okay, so here's another good question. I understand GDP payroll information is more or less, so GDP/payroll information is more or less an indicator that can help us understand what's happening with the economy. But in case we directly use this in making a decision to buy, hold, or sell a stock, are there any specific type of stocks that are very sensitive to this? For example, if GDP is going down, maybe I should sell stock X or so. Let's say all other factors are ignored. Well, the classic example of what might be more affected by what's going on with payroll data, and in other words, data pertaining to where we are in the cycle, are cyclical stocks. So we get this kind of definition of certain stocks we call cyclical, and we talked about this in our first 2 presentations, or I think in the first one maybe. Cyclical stocks, and we get non-cyclical stocks. So for example, a cyclical stock is one that relies on discretionary spending. So it's, if a company sells luxury sports cars, maybe they're more affected by discretionary spending, or restaurants or airlines, luxury hotels, holiday resorts, these sort of companies, they're going to be very much more affected by if there's a downturn in the economy, because consumer spending will become constrained and it will affect them more than, for example, a company that makes deodorant. Because, I don't know about you, but for me, I need deodorant just as much, even if there's a downturn in the economy, than if it's expanding. So you get companies that make essentials that people don't cut back on buying those, even though there's a downturn, quite as much as they do on the stuff that's more to do with discretionary spending. So, and if you want to specific companies, any company that does luxury hotels, airlines, British Airways, probably going to do badly if the economy tanks. Then one of the big companies that makes like shampoo and toilet paper and deodorant. Another question is, it's another one of those I haven't got across the ball answers. What is your honest opinion and analysis on whether a recession is currently looming? It's constantly being said since the pandemic, but nothing has happened. A recession somewhere will be on the horizon somewhere. How close it is really is how long is a piece of string. As I said before, you just got to keep looking at the data, see what is happening, and react to what you actually see happening. Another request for the registration, which we sent. Please. So, Matty, maybe you can help out with this one. Someone's saying, can you share the slides with all registrants? Thank you.
The slides we're not sharing, but you all can re-watch literally every time, every day at your time. I just shared the link to the landing page we built for this course. So literally you just go to the link and watch it again. We just don't share it because, we want to keep it so it won't run in the network and everything. So I'm sorry for that.
Cool. Okay. And then so I've got another one here. Hi, can you please give a quick clarification? How would increasing the interest rate by the Fed impact stocks? Thanks. Well, there's different ways it could affect stocks. First of all, we have to sort of work out whether it's in line with expectations or not. So if the Fed hikes rates, if that was fully expected, we'd expect it to have limited impact on stock prices short term, because we would expect the market to have already priced it in. So there's an economic theory, which is the idea of the rational market, which means that all known information will be priced in by prices. So in reality, the market will probably price in, because they don't know for sure the Fed's going to hike rates, they probably have priced in some of it. So there might be a short-term negative reaction to that in theory. Because as they hike rates, in theory, all other things being equal, it should be bad for stocks, just because it hikes, well, it tightens the money supply. So a tightening policy means effectively that there's just less money sloshing around, and it means that therefore it's a bit harder for companies eventually to maintain their sales, to generate profits. So, if you take it to the example I said before, is that eventually, so this, we're now starting to talk longer term, if the Fed hikes rates, eventually it will people's mortgage rates will get hit by that in theory, and then they end up paying bigger mortgage payments each month, and then consumers should in theory spend a little bit less. Obviously there's always much more complicated story than this. In reality, there's all these things are tied together, and that, which is why we get this big sort of, when we talk about the business cycle, it's this aggregate thing where lots of things are tightening together, contracting together, and lots of things are expanding together in the expansionary phase. So in the contractionary phase, which could be precipitated by the Fed hiking rates, you sort of, spending gets a bit less, so there, and then companies make a little bit less profit, they report a bit less profit, as things are a bit harder to make sales, and then that can, maybe they start hiring a bit less, or maybe if things are bad enough, they might actually lay off a few workers, and then the workers who've been laid off, they then feel like, I can't spend as freely, so it hits consumer spending again, which has a knock-on effect on companies, and you which is why you sort of get this cycle of it happening. But to give a very simple answer, the Fed loosening monetary policy should be good for stocks. The Fed tightening policy should be bad for stocks, all other things being equal. And just thinking that's a very simple general level. And I think that is pretty much taking us to the end of our time for today. Some really good questions in there. I actually enjoyed that. Pretty tough questions. Please join us again next time. Thanks very much for attending, everyone. I hope you enjoyed the talk. I had a few nice comments from people saying that they did appreciate it and they did enjoy it. So, I appreciate you for appreciating me. Join us again next time. We're going to be looking at technical analysis, dipping our toe in the first part of that. We're going to do a few talks about technical analysis coming up. And next week's one is the first part of that, when we're going to be looking at trends. So thanks very much for attending, and I'll see you next time. Bye, everyone.
Thank you all. Bye bye.